folks. Ever wonder how investors decide where to put their money? What makes a business say, this campaign is worth every penny? Or an entrepreneur shout, this was the best decision ever? Well, today we're diving into the world of ROI, return on investment. It's simple, powerful, and sometimes a little misleading. But hey, that's where the fun begins. So, what exactly is ROI? Let's break it down. ROI is like that report card you get after an investment. It tells you how much you've gained or lost compared to what you put in. Let's now look at how ROI is calculated. So return on investment is equal to net profit divided by the investment cost times 100. And just like in school, nobody likes seeing an F in the ROI department. Here's an example. Imagine you invest $1,000 in a business and get back $1,200. The ROI? A respectable 20%. But what if you invest $1,000 and only get $900 back? That's a negative 10% ROI, aka ouch. Now, why do people love ROI? First off, it's super simple. You don't need to be a Wall Street wizard to calculate it. Plus, it's universal. You can use ROI for stocks, real estate, marketing campaigns, even that coffee shop you want to open. And the best part? ROI is your trusty guide to compare investment opportunities. Say you have $10,000. Should you start a dog walking business or invest in a cupcake truck? ROI will help you sniff out the better deal. But like that mysterious friend who's too perfect, ROI has its flaws. For starters, it doesn't care about time. You invest in something that gives you a 30% ROI, sounds amazing, right? But if it takes 10 years to get there, was it really worth it? And let's talk about risk. ROI doesn't factor that in. Two investments might both promise 20% returns, but one could be as safe as a savings account, while the other is as risky as betting on a llama race. All right, let's get real. What does ROI look like in the wild? Example 1, stocks. Say you buy $5,000 worth of stocks, and a year later, they're worth $6,000. Add in $200 in dividends, and your ROI is not bad for a year's work, right? Now, let's jump to real estate. You buy a house for $300,000, spend $50,000 on renovations, and sell it for $400,000. At what? Drum roll, please. 14.3%. But let's not forget marketing. You spend $1,000 on a social media campaign, and it pulls in $2,500 in sales. That's a whopping 150% ROI. Your boss is giving you a raise, guaranteed. So how do you get that sweet, sweet ROI? Step 1, cut unnecessary costs. For example, if your business can save $500 by switching to a cheaper supplier, that's an instant ROI boost. Step 2, maximize your revenue. Focus on high-value customers or premium products. And step 3, don't put all your eggs or investments in one basket. Diversify, baby. But let's keep it real. ROI isn't perfect. It's just one piece of the puzzle. To really understand your investment, you need to look at other metrics too, like net present value, NPV, or internal rate of return, IRR. And remember, ROI can be manipulated. Forget to include certain costs or overly inflate revenues. And suddenly your ROI looks like a rock star when it's really... So, is ROI the king of financial metrics? Well, it's more like the quarterback of the team. Important, but not the whole story. Use it wisely, pair it with other metrics, and you'll make smarter decisions. Whether you're an investor, a business owner, or just someone trying to figure out if that gym membership was worth it, ROI is here to help. But remember, don't let it fool you. Thanks for watching. If you learned something new or just had a good laugh, smash that like button, hit subscribe, and let me know in the comments your best or worst ROI story. Until next time, keep investing wisely.